The 30-year Treasury just hit 5.1%. Is the bond market breaking? 5.121%. That's where the 30-year U.S. Treasury yield closed on Friday, May 15, 2026, the highest level in over a year, and closing in on levels not seen since October 2023, a period that sent shockwaves through stocks, real estate, and every corner of the financial system. Now, if your eyes just glazed over at the phrase Treasury yield, I need you to stay with me for the next 30 seconds, because this number affects your mortgage payment, your bond funds inside your 401k, your home equity, and the value of your stock portfolio, all of it. Here's what we're going to cover. What exactly is happening in the bond market and why it's happening now? What rising yields actually do to your money in plain terms? Why the Federal Reserve's leadership change is making this worse, and what a typical retail investor should actually think about doing with this information. This isn't doom and gloom. It's a blueprint for understanding one of the most important forces in investing, and most people have no idea how it works. Let's change that. Let's start with what happened this week and why the bond market moved the way it did. Treasury bonds are essentially loans you give to the U.S. government. When you buy a 30-year Treasury, the government pays you a fixed interest rate for 30 years. The yield is the annualized return on that loan. And yields move in the opposite direction of bond prices. When yields go up, existing bond prices go down. We'll come back to why that matters in a moment. This week, yields spiked across the entire curve, not just the 30-year. The 10-year Treasury note, which is the benchmark that mortgage rates follow most closely, surged 13 basis points, that's 0.13 percentage points, to 4.591%. The 30-year went up 10 basis points to 5.121%. Even the 2-year note, which tracks short-term Fed expectations, rose 9 basis points to 4.084%. Two things drove this move. Now let's get to the part that actually matters for your money. Rising yields ripple through three areas that affect almost every retail investor: your bond holdings, your housing costs, and your equity portfolio. Here's the thing most people don't know about the bond funds inside their 401k or IRA. When yields rise, the value of existing bonds falls. It's a mathematical relationship. Think of it this way. Imagine you own a bond paying 4% interest. Now new bonds come out paying 5%. Who wants to buy your 4% bond? Nobody. Unless they get a discount. That discount is how the market reprices bonds when yields go up. The longer the bond's maturity, the bigger the price drop. A 30-year bond is far more sensitive to yield changes than a 2-year bond. The iShares 20-plus year Treasury Bond ETF, ticker TLT, tracks long-duration treasuries and has been one of the most brutal losing trades of this rate cycle. Investors who held long-term bonds expecting rate cuts have been waiting years for relief that hasn't fully arrived. If you have a total bond market or bond index fund in your retirement account, it holds mostly intermediate duration bonds, 5 to 10 years. It's less extreme than TLT, but rising yields still reduce the current value of those holdings. This is not a reason to panic and sell. Bonds are still an important diversifier, but it is a reason to understand what you own. The 30-year fixed mortgage rate was already at 6.37% as of May 7, 2026. After Friday's yield spike, the next weekly reading will almost certainly be higher. Mortgage rates track the 10-year Treasury with a spread historically around 2 to 2.5 percentage points. With the 10-year now at 4.59%, you'd expect mortgage rates to be in the 6.5 to 7% range in the coming weeks. Why does this matter for investors who already own their home? 3 reasons. And for the broader economy, a housing sector under yield pressure is a drag on construction, employment, and consumer spending. This feeds back into the macro story. This is the connection most investors miss between bond markets and their stock portfolio. When risk-free Treasury yields rise, meaning you can earn 5% on a government bond with zero default risk, Two things happen to stocks. First, the discount rate used to value future earnings goes up. This hurts growth stocks most. Companies like software and biotech, whose value is based on profits expected years from now, are worth less today when you discount those future earnings at a higher rate. The NASDAQ, which is heavy in growth stocks, fell 0.9% on Friday and is showing signs of momentum exhaustion after its recent all-time high above 22,425. Second, income-oriented sectors become less competitive. When investors can get 5% from a US government bond, a utility stock or REIT, paying a 4% dividend suddenly looks less attractive. Real estate investment trusts and utility stocks have been among the weakest performers this week. The S&P 500 itself retreated from its all-time high of 7,514, hit just one day before on May 14th, and closed lower on Friday. The index has strong support at 7,200. As long as it holds above that level, the bull case remains intact. But persistent yield pressure is a real headwind for the multiple expansion story that drove the index to record levels. Let's briefly touch on what's happening in other risk assets, because the bond market doesn't move in isolation. Bitcoin retreated to around $81,000 this week, and crypto-related stocks took a significant hit. Coinbase fell roughly 8%. Strategy, the company formerly known as MicroStrategy, dropped around 6%. Circle, which had rallied after earnings, gave back those gains and finished the week negative. This isn't a coincidence. When 30-year Treasuries yield 5.1% with zero credit risk, the appetite for speculative volatile assets decreases. Investors who were willing to hold Bitcoin or crypto equities when safe yields were at 3 or 4% recalibrate when they can earn 5% in government bonds. This is what the market calls risk-off. The same dynamic applies to unprofitable tech companies, highly leveraged businesses, and any asset that requires investors to be patient and optimistic. High yields compress that patience. This is why the bond market is sometimes called the smartest money in the room. When yields spike, everything from growth stocks to crypto to emerging markets tends to feel the pressure. Understanding that connection helps you interpret seemingly unrelated market moves as part of one unified macro story. Let's look at the charts, because data is more useful than opinion. Starting with the S&P 500. The index just hit a fresh all-time high of 7,514 on May 14th and then sold off 0.7% the very next day. That kind of reversal from an all-time high is something to watch. It doesn't mean the bull market is over, but it does indicate that the market is sensitive to yield pressure at these levels. The chart shows two levels that matter right now. Support sits at 7,200, a zone the S&P 500 has repeatedly held, and that represents the previous all-time high from earlier in the year. As long as the index trades above 7,200, the bullish structure remains intact. The next key resistance above Friday's close is in the 7,285 to 7,350 range. A sustained break above that zone on strong volume would signal that the yield anxiety is being absorbed and buyers are back in control. The technical indicators currently show a strong buy signal on moving averages with RSI above 70, meaning the market is overbought on a short-term basis. Overbought doesn't mean sell. It means the index is extended and more vulnerable to pullbacks on negative catalysts. A 5.1% 30-year yield is exactly the kind of catalyst that can trigger a short-term correction from overbought conditions. Now the NASDAQ. The index recently broke to fresh all-time highs above 22,425, confirming the bullish breakout structure, but momentum indicators are showing signs of fatigue at these levels. The NASDAQ fell 0.9% on Friday, slightly more than the S&P, which is consistent with growth stocks repricing against higher yields. The level to watch on the downside is that prior ATH at 22,425, now a technical support zone. A close below it would be an early warning signal for near-term weakness. Now let's look at the yield chart itself, because this is the one that's driving everything else. The 30-year Treasury yield chart shows a clear trend. Yields have been rising since the lows of early 2024. The spike to 5.121% on Friday brings the yield back to its highest level since May 2025, and it's now testing the area just below the October 2023 multi-year highs. If the 30-year yield breaks and holds above 5.2 to 5.3%, it would represent a new multi-year high and would likely trigger another leg of risk asset repricing. Finally, the sector performance picture. Year-to-date, energy is among the strongest sectors, up significantly on the back of $100+ oil. Financials are mixed. The weakest performers are the rate-sensitive sectors, utilities, real estate investment trusts, and consumer discretionary. That rotation out of yield-sensitive sectors and into energy and financials is a textbook response to a rising yield environment. So what do you actually do with this information? Here are 3 things worth thinking about, and I want to be clear, none of this is investment advice. This is educational context for understanding your own situation. If you have a 401k or IRA, log in and look at your fixed income holdings. A total bond market index fund like Vanguard's BND or Fidelity's FXNAX holds mostly intermediate-term bonds, 5 to 10 years. These are less exposed to yield spikes than long-duration funds, but a fund labeled long-term bond or tracking 20-year-plus treasuries has significant exposure. In a rising yield environment, the duration of your bonds matters as much as the amount you've allocated. The mortgage rate that gets quoted to you next week will reflect this week's yield spike. If you're in the middle of a refinance decision, understand that the calculus just changed. And if you're sitting on a variable rate HELOC, your rate is tied to short-term benchmarks, and with the Fed now pricing in potential hikes, that variable rate isn't going lower anytime soon. We know that 4 Federal Reserve members dissented at the last meeting, the highest number since 1992. The minutes will reveal what the disagreements were about. If the dissent was hawkish, meaning some members wanted to raise rates, the 30-year yield could push even higher. If the dissent was dovish, we might see yields pull back. That report is worth watching if you're paying attention to the macro environment. None of this requires you to make trades or change your long-term allocation, but understanding what's happening and why puts you in a much better position to make calm, informed decisions when the market gets noisy. Let's bring it together. The 30-year Treasury hitting 5.1% is not a random number. It's a signal that markets are repricing risk across the entire financial system, because when the price of the safest asset in the world goes up, everything else adjusts around it. Bond funds lose value, mortgage rates rise, growth stocks get repriced, and risk assets like crypto pull back. These aren't separate stories. They're all the same story. If this video helped you understand why bond yields matter and how they connect to your portfolio, do me a favor, drop a comment below with one word describing how you feel about the bond market right now. And if you're new here, subscribe. We cover exactly this kind of macro to personal finance connection every week. This video is for educational purposes only and is not investment advice. Always consult a licensed financial professional before making investment decisions.